JNK. Now, this is an ETF that tracks Barclays High Yield Bond Index, created back in 2007, which, come to think of it, I was there at the time. Now, high yield bonds are challenging even in the best of times, but during a pandemic, even more so. And yet, knowing and understanding the wave principle gives you a unique insight and clarity, not only about where bonds like JNK have been, but potentially where they're going next.
So let's dig a little deeper into this chart. The first thing you may notice, simply put, since the March 2020 low, is it is a bull market. It, simply put, is going up. From an Elliott perspective, you also may notice, while it may look impulsive here, it certainly looks like it's an overlapping, non-impulsive move to the top side. So how might one understand that in real time? Well, let's start off with the bull market indeed. Traditional bull market, higher high, as you can see in red here, higher lows. So higher highs, higher lows, indeed a bull market. But Elliott allows you to go one step further. In the first decline, as you can see here, in the spring of 2020, it was clearly a three-wave decline. A three-wave decline is a counter-trend move. So even in the decline, you would have said, from an Elliott perspective, there's further upside to go. Going forward, the next decline, as you can see in the summer of 2020, yet again, another three-wave decline. So in real time, one may have been tempted to go 1, 2, 3, 4, 5. However, the three-wave decline here suggests that this impulsive move may not be exactly what it seemed. Correction lower, further to go to the top side. And finally, of course, in the fall, we saw yet another three-wave decline. So you had a three-wave decline here, a three-wave decline here, and a three-wave decline here. So despite the overall choppy pattern, the Elliott pattern was telling you that the downside was corrected. Further, from a momentum point of view, each three-wave decline completely unwound the overbought condition and put the market in a clear oversold condition, setting up for another move to the top. So putting it all together, it was and seems to be a complex correction. A, B, C, wave X, A, B, C, wave X, and potentially further A, B, C to go. So the three-wave decline helped one understand from an Elliott point of view that the downside was still corrective, an overall complex correction that's continuing to have further to go, but still within the frame of an overall bull market.
An ETF representing high yield bonds in a pandemic, in a complex correction. And the wave principle gives you distinctive insights into not only the trajectory, but the unfolding pattern. If it can do that for something as complex as high yield bonds, imagine the applications for other financial assets.